Hello, this is Roger Royce. I'm the founder of the Royse Law Firm. We're a business, corporate, and tax law firm in Menlo Park, California. Offices in San Francisco and Southern California, and I'm here today to talk to you about our blockchain initiative. And the Royse Law Firm now works in a variety of industries. We're a full-service firm, but we are very much committed to blockchain industry and blockchain technologies, enabling our clients and the performance of their services and delivery of their products, as well as more creative uses such as fundraising. So we have created a blockchain initiative, and for the next 8 lectures I'm going to be talking about blockchain as we see it, the technology, the business use cases, and most importantly the legal and regulatory environment. So for today, what I'd like to do is just go over a summary of the high level of what the next 8 lectures will cover. And again, I'm going to hit these at a high level on the technology, the business cases, and the legal environment. So blockchain, as you probably know, is a new technology, or relatively new, or I should say a combination of technologies that's created new business models that has a lot of qualities that are oftentimes described, set forth in this slide. And all of these are more or less true. For example, it's said to be anonymous, or more accurately pseudonymous. In other words, we don't know who the person is behind a transaction. All we know is what their address is. So it's pseudonymous. There's some concern that some of these identities could be reverse engineered through powerful artificial intelligence, but for the most part, we say that blockchain is pseudonymous because of this reason. Immutable, meaning it's unchangeable. One of the central defining characteristics of blockchain is that it's decentralized, and all the data rests on a number of computers, not just one, so it's very hard to change something once the transaction's been recorded on all those computers. You would theoretically have to change a transaction on numerous computers instead of just one. So we say it's immutable or unchangeable. It's transparent. Every computer in the system can actually see the transactions, see what's happened. It makes it very secure. When talking about cryptocurrency, for example, we use cryptography. That's why they call it cryptocurrency, which we'll talk about in a little bit. Strong cryptography. It's immediate, or relatively speaking. It can happen peer-to-peer immediately. In practice, however, because of some of the consensus algorithms, it actually is not so immediate. Frictionless, meaning that there's very little cost, very few people involved. Again, peer-to-peer creates a lot less, we'll call it drag on the system, intermediaries, time delays, cost delays. And of course, it's trustless. We don't go through a trusted central party, it just happens between parties. So let me break that down a little bit and talk a little bit about each one of those aspects. So number one, I said that blockchain was a distributed ledger system. That's not all that it is. Distributed ledgers have been around forever. It just makes use of distributed ledger in its system. So, for example, think of a public internet-based digital ledger that records transactions between parties on the network. So it's not just a ledger that the two parties have, but everybody in the network can access this ledger. It's public, it's on the internet, and it's peer-to-peer. So rather than a central party maintaining a ledger of transactions, everybody on the network maintains a ledger of every transaction on the network since the date of creation. That's what a distributed ledger is. That's part of what underlies blockchain. It's secured by encryption. All the participants are what we call nodes, meaning that each one actually maintains an identical copy of the ledger, and they record all of the transactions. Those are nodes. So how did we get here? My background before I became a lawyer is accounting. So I like the accounting description of blockchain technology. There was a time when there was no such thing as double entry accounting. Parties could only record whatever happened with no way of self-verifying and checking those numbers. Double entry accounting was the concept that debits must equal credits. For every debit, there's a credit. There's a way for companies to actually self-verify and internally check that there were no mistakes made or errors or fraud in their transactions. double entry accounting has really revolutionize accounting, and it's because of double entry that commerce was able to be done, and that corporations were able to exist. There would be no corporations if there were no double entry accounting. Of course, the problem with that is that there is still a potential for fraud. There's still a potential for mistake because it's only one central party that's maintaining that ledger. I think of a distributed ledger as triple entry accounting. It's not just you've got your debits and your credits which have to equal, but you also got this third proof, or this third control, which is the public ledger that is sitting out there in everybody else's computer. And the way that double entry accounting really revolutionized how commerce could be done, I think distributed ledger technology or triple entry accounting is going to revolutionize, again, the way that business can be done. So how did we get here? So the idea of digital cash, for example, is not new. It's been around forever. Milton Friedman predicted this many years ago. In the 90s, we had a digital cash product called eCash that came along. It was very early, and it almost took off. It suffered from one problem, and that's that it had a central authority. When a central authority that verified or validated transactions went bankrupt, the whole system failed. Since then, we've had other peer-to-peer technologies, Napster probably being the most famous early or precursor of peer-to-peer. You remember Napster was music sharing peer-to-peer. Each person could share music. They kept it on their own computers rather than on a central computer. The problem with Napster is, again, we had a central registry, or think of it as a table of contents, that actually was the thing that really caused Napster not to succeed. BitTorrent is a similar concept. It's peer-to-peer file sharing, same idea. So the idea of peer-to-peer has been out there for a while, and it's been evolving. So when we say peer-to-peer and decentralized and distributed, here's what we mean. Centralized is what the internet started as. It's the idea that we have one central authority that usually sends messages just one way, and everybody has to transact and communicate through that central authority. Think of a bank, right? The bank maintains the ledger of your money, and they will tell you how much you have, and they will tell you when you can spend it, when you have enough to spend. They validate the transactions. Decentralized is the idea that you have many authorities, not just one, but a lot of different authorities that are validating these transactions. But purely, truly distributed is the idea that each one of the peers in the transactions, each one of the parties can talk to any other party in a transaction and doesn't have to go through anybody else. That's where blockchain technology is, or can be. It was probably the financial crisis of 2008 that really gave blockchain its start, because that's when Bitcoin took off, was right after that, and it took off based on and because of the public lack of trust in our banking system. We saw a financial crisis, and a lot of people blamed the bankers, and they blamed the incentive systems that were put in place at the time that really did not reward the community, but rewarded individual parties. So it was that lack of trust that really gave Bitcoin and cryptocurrency the launch pad that it needed to gain some control, and that's when it was launched. We'll talk more about that when I talk about cryptocurrencies. So the thing about Bitcoin is that it's a very simple sort of protocol. All it really does is it transmits messages. It can't run contracts. It's not what we call Turing complete, meaning that it could do computations and calculations without going into an infinite loop. So Ether came along, and Ether also can be used as a currency. It can transmit messages, but it can also run smart contracts. In other words, it's what we call Turing complete. It can do calculations. And we could put these things called dApps, distributed apps, on top of Ether, so applications could run on top of the blockchain. And that was the next evolution of blockchain technology. And based on that, businesses were able to simply tokenize or turn their assets into digital assets through the use of this blockchain technology. after the advent of dApps and smart contracts. We'll talk a lot about that. So the problem blockchain solved was really the elimination of the intermediary. That was number one. So think in the financial sector, for example. Traditionally, how did transfers work? If these two parties wanted to exchange money or transfer money to another person, it was quite a challenge, right? Look at all the parties that were in between those transactions. With blockchain, we eliminate those intermediaries and the transaction can happen right between these two people. So we take a lot of the friction out of it. We take the intermediaries out of it. And what does that allow us to do? Well, if you think of the internet as allowing the digital transfer of information, you can think of blockchain as allowing the digital transfer of products. And it does so in a way that reduces the cost of verification, because you don't have to pay the intermediary to verify those transactions, and reduces the cost of networking, because it's a lot less expensive now to get the network effect. In other words, to get a lot of people in the community to join the community, because there are ways that we can incentivize them to do that. We'll talk more about that when we talk about cryptoeconomics. So let's talk a little bit about the technology here behind blockchain. I've already talked about the distributed ledger. I've talked about the decentralized part of it. I want to talk about some of the other things that make blockchain really work well. Cryptography, consensus mechanisms, how hashes work, what miners are, what they do in the process. So here's an overview of a blockchain distributed ledger system. So when an exchange occurs, say transfer of Bitcoin from somebody, so step one, the exchange is encrypted. Okay, think of a password for your email address. We put in strong encryption so the message can't be tampered with or intercepted by somebody else. All of the nodes, that's the computers in the network, communicate with each other and they record the exchange. There's a system, a consensus algorithm we call it, that assures the validity of those transactions so we know we're not dealing with fraudulent transactions. And once validated, all copies of the ledger then are updated. The mining nodes, or the miners, they bundle these transactions into blocks of data and then add them to the ledger. And each block has information that refers back to the previous block. And they're all linked together in a chain through mathematical hash functions. That's why we call it a blockchain. And the miner actually can secure the block after they calculate the correct hash value. Once those entries are entered and been validated and accepted, they can't be deleted, they can't be changed, theoretically. All right, let's talk a little bit more about some of these aspects. Number one, the cryptography. We call it a cryptocurrency because it's based on very strong cryptography, public-private key cryptography. So here's an example. Alice is going to pay Bob, right? So what she does is think of sending an email message and you're using your private password. By the way, before this type of cryptography, messages were sent over the internet with passwords being sent over the internet, which could be intercepted. So it was not very secure at all. So we needed a way where we didn't have to send that information over the internet in an insecure fashion. And cryptography uses mathematical algorithms to do that. So Alice can encrypt a message with her private key. It gets sent with her public key. Anybody on the network can see that Alice has sent this message, but only Bob, who has Alice's public key and his private key, can actually decrypt that message and receive the message, receive the currency. So here's how this works. Alice will say has a Bitcoin wallet, which is how a lot of these are done, with addresses, each of which refers to a balance of Bitcoin. So Bob creates a new Bitcoin address for Alice to send that Bitcoin to. Alice tells her Bitcoin client to transfer the Bitcoin to Bob. The client signs a request with Alice's private key. Anyone on the network can see that transactions happen, but only Bob has a private key that can open that message and receive that Bitcoin. The Bitcoin transaction is verified. Any blockchain transaction is verified by nodes. Those are the computers on the network keeping track of everything. Once verified, they sit in the memory pool or the mem pool until the miners bundle the transactions into a block. And in Bitcoin, it takes about 10 minutes. And if a user has enough Bitcoin, the transaction is going to be deemed valid and bundled. Otherwise, it's going to be rejected. So the block, as I said, transactions are grouped together in blocks. That's why we call it a blockchain. The block contains a list of data, a group of transactions, and they link together sequentially through timestamp chains. And each block contains information about the transfers, and they all are organized with headers which have a unique hash. I'll tell you what that is in a minute, a timestamp and identifier of the previous block. So in a centralized system, we would have a banker, for example, or some trusted authority or intermediary that could verify the transactions and create and store the blocks. But how do we do this in a distributed system? In a distributed system, the collective verifies, not any private trusted authority. So how do we trust that block? And who's allowed to store information on that blockchain? So let's talk about verification. So in a system like Bitcoin, what happens is that, as I said, the miners bundle the data into a block. Now then they're going to create a hash. Now a hash function, and hashes have been around forever, it's nothing new, but a hash function takes data of arbitrary size and it turns it into code of a fixed size. So the values returned by that hash function, that program, are called hash values or hash codes or just hashes. So in Bitcoin we use a nonce, which is just a random number which is used to create different hash values from the same data. And the miner will just keep running that calculation using different nonces again and again and again until they come up with a hash value that meets a mathematical requirement. And in Bitcoin, the mathematical requirement is it has to have a certain number of leading zeros. And until it does that, we don't have a hash function, we don't have a validation of the information in the block. But once that's done, once we do get a hash with a number of leading zeros, then that miner has won, and he has the right to basically validate that block and create the hash for it, and then create the next block. So that's the system. Now, why does it happen that way? It's because it's really expensive to come up with that hash value that has the right number of leading zeros. It's really expensive to do that mathematical calculation. It requires trial and error. It takes a lot of computing power, and just the high cost of mining prevents fraud. Solving that puzzle is called proof of work, by the way, and proof of work is a consensus mechanism that theoretically will prevent fraud because it would just be too expensive for somebody to go through the mining process if they weren't sure that they were going to win. So here's what the block looks like. Here's an example or a visualization. We have a header, right? It's got version info, it's got a nonce in it, it's got the previous block, it's got a timestamp, and the information that is in the block. And you'll see that this is block number 101, which sits right on top of block 100, and comes before 102 probably. Now you notice I mentioned the idea of a Merkle tree. The Merkle tree we'll talk more about later, but that's a mechanism for proving all of the information has not been tampered with inside the block. And the idea is that we don't have to go look at every piece of information in the block or look at every hash. All we have to do is look at any piece of data in the Merkle tree, and if any piece of data is inaccurate, it will actually affect all of the data in the hash tree. Let's talk about consensus mechanisms. Proof of work is the one I mentioned. That's the one that Bitcoin uses. It makes it computationally really costly for a network user to validate the transactions. The benefit of that is that it really keeps down the number of network identities somebody's going to, make up in order so they can go out and validate transactions because it's so expensive. It rewards the winners who actually do validate the transactions by paying them fees in Bitcoin. So that's the system for getting people to use it. That's the system to keep from being fraudulently used. The problem with proof of work, of course, is that it requires a lot of energy. Here's an example of some of the energy that's required by Bitcoin. It's massive, and it is a problem. So some people have come up with another system called proof of stake. This is an alternative consensus algorithm. So instead of this mathematical contest that people try to win in order to get the right to validate the block, the miners put up a stake in return for the right to validate the block. And if they are mistaken, or if they're erroneous, or if they're fraudulent, they lose their stake, because eventually it'll get figured out. Stake is a non-revocable, think of it as a security deposit. That's proof of stake. It's faster. It doesn't use the kind of energy proof of work does. It's probably not quite as secure, however. There are other systems. There's plenty of other systems. One, delegated proof of stake. That's where we just have elected delegates who are going to determine. So not everybody in the system, just a small group of elected delegates who get the right to validate the blocks. There's one interesting one from MIT called Algorand, which is really a lottery system that randomly selects the parties that get to validate the block. Chia coin is a new type of cryptocurrency that uses something completely different, just proof of storage, rather than proof of stake or proof of work, just proof of storage to determine who has the right to validate the block. So let's talk about forks and double spend. It's a big problem in cryptocurrency. Remember my example of Alice transferring Bitcoin to Bob. Well, suppose that she decides to transfer that same Bitcoin to two different people, and the nodes verify both of those transactions. Well, how could that happen? Well, keep in mind that cryptocurrency is simply computer code, and it can easily be copied and transferred again and again and again. It's not like a physical coin or a physical piece of tender. It's something that can easily be copied. So that's the double spend problem. How do we keep that from happening? So here's a graphic that illustrates it. Here's Alice. Like I said, she transferred the first coin to Bob, but she also transferred an exact copy to Matthias here. And then they went on and they transferred it. Well, how do we keep this from happening? Right? It looks so easy. Well, the way that the blockchain system works to keep this from happening is very similar to the way that nature works, the way that fish decide which pool to join, birds decide which flock to fly with. And that's the miners will pick the longest chain. So what does that mean? So this is a double spend. It's also known as a fork. So we've got block, okay, validated. Next block, add transaction, validated. Now we got the double spend, and all of a sudden we've got two separate blocks, and usually what will happen is one will get validated and then the other one won't. But let's suppose both of these get validated. Well, now what? Well, you see that block B then gets added to and gets validated. And that's the longer block. And that is all, once it becomes longer, that's the one that's validated, and the shorter block just goes away. It just is undone. It's totally invalid. And that's a proxy for determining who's first in time, because theoretically block B is likely first in time if it's the longer block. And in the real world, or in the non-crypto world, what would happen is somebody tried to spend the same money twice. The person that they purchased from first would be the party whose transaction would be the valid one. There would never be a second transaction. And this is somewhat of a digital proxy for that idea. So the longest chain gets validated, and once we do validate these longer chains, then the old ones go away. Integrity of the blockchain, there's this concept called a 51% attack we'll talk more about, and that's the idea that theoretically the miners could just collude to just approve false transactions, but it's doubtful that you're going to find anybody with that much computational power, although we'll talk more about that in a further lecture. It's not actually that far-fetched today. Okay, the last thing I want to mention on technology is we have this concept of permissioned and permissionless networks. So I've been talking about permissionless networks, meaning that anyone can go on and can be a node on the blockchain. If you got a computer, you can be in Bitcoin, right? It's slower, but it's probably more secure because it's much bigger. You have much more nodes out there validating transactions. Open and transparent. What we see mostly in blockchain now, with dApps especially, is what we call permissioned systems, meaning that you don't let just everybody in the world join. It's private membership. They somehow have to have a reason for being there. Maybe they're the group of customers or the group of farmers in the agricultural product blockchain or whatever it is. And that is not entirely trust-free. It's somewhat trusted because you're trusting the people in the system. And because you know who they are much more likely to be subject to legal recourse. Whereas in a permissionless system, there's so many of them, you don't know who they are. It's just the public. We call that illegal. It operates outside the legal system. So keep that in mind, permissionless. Okay, I'd like to move on now and talk briefly about the business cases for blockchain. Why is this such a big deal? I mean, that's all really interesting, all this technology and strategy and how it all works, but how do we make any money out of this? So let's start by saying that there's a real dark side to blockchain that everybody has heard about. Mt. Gox, right, a big exchange which got hacked, lost about $400 million worth of Bitcoin, just disappeared. Everybody knows about that. The Silk Road, right, using Bitcoin to engage in illicit transactions. That's the dark side. But what is the legitimate market opportunity in blockchain? Well, let me give you some numbers. So Bitcoin's about a 200 billion, it's a little less than that today, probably a lot less than that today, given that I'm doing this talk at the end of November 2018. But in 2017, it was a $200 billion market, according to McKinsey. And they estimate that by 2027, in less than 10 years, it'll be 10% of the global GDP. Right now, cryptocurrency is less than 1/2 of all of the capital markets. But blockchain itself could be very big. VCs are investing in this. We had a very big ICO market last year. We're going to talk a lot more about that later. And IBM has been very active in this, putting hundreds of $millions in developing blockchain and IoT in several sectors, such as food and egg distribution. So we like to call blockchain a foundational layer or foundational technology, meaning that applications build on top of it. So think about the internet, right? The internet is a foundational technology that applications like Google, Amazon, and Facebook can build on top of. The idea is that blockchain might go the same way, where most of the value is not going to be just the messages that get exchanged, but actually the dApps, that's the distributed applications that are built on top of the blockchain, Ethereum being the most popular one right now. So again, how long will it take to become ubiquitous? And people like to mention that, the TCP/IP protocol on which the internet is based was started back in 1972. It really took about 30 years, to become as big as it is now. I don't think it'll take blockchain that long, and here's why. Let me talk about some economics, how blockchain is going to be big and how it's going to shape innovation. So number one, the real power as a business matter of blockchain is that it reduces two big costs. One is the cost of verification. That's just the cost of verifying and validating those transactions. The way it works now is we use intermediaries to verify transactions. Blockchain eliminates the intermediaries because it digitizes each asset and it uses the community to verify the transaction. Now, once the cost of verifying transactions goes down to close to zero, that means a lot of transactions that before just weren't economically viable, businesses that weren't economically viable can start now, right? Because in any business where the cost of verifying a transaction was higher than the benefit of the transaction, that business would never see the light of day. Well, if the cost goes down, all of a sudden there's some value that can be offered there. We'll talk more about that later. I'll show you exactly what I mean, how new businesses are emerging just because of costless verification. Secondly, reduces the cost of networking. So networking is the idea of creating a marketplace. In other words, getting a lot of people together that are actually going to participate in the market. Facebook, for example, relies on its network. If all your friends weren't on Facebook, you wouldn't be either. It's the network effect. It's very important. It's very expensive currently to go out and create that marketplace. You need a trusted intermediary that can drum up the business. The idea behind blockchain is that we can put in place cryptoeconomic incentives that bring that cost of networking down quite a lot so that we can create big networks without spending a lot of money. The result, I think, is going to be increased competition. It's going to be low barriers to entry. Privacy risk could go either way, but probably lower privacy risk and shared investment in infrastructure. It will certainly open up new industries, new markets, and new ways of doing business. So zero cost verification, let's talk a little bit about that. We know what I mean by that, right? We're getting rid of the middleman, but by some studies, 70% of the value of blockchain is in cost reduction, right? 70% of the value. That's why parties are going to use it. That's why we're seeing permissioned blockchain systems, which is sort of contrary to the idea of having it distributed everywhere and completely trustless. A lot of companies are saying, you know what, that's nice, but what we're really interested in is the fact that we can get the cost down. And a lot of companies are implementing blockchain just for that reason on its own. Network effect we talked about. It's also called network externalities or demand side economies of scale. And again, that's a positive effect to a business by having additional users using the product, right? Think of social media. The more users you have, the better. And that is a very big cost for startup companies in technology right now. Blockchain can lower that cost to almost nothing through cryptoeconomics. So again, is blockchain foundational or disruptive? Based on what I've said, I think you might conclude it kind of has features of both, but you can see that it is very much a foundational technology that can be used to enhance existing technologies and existing businesses, although I'm sure that there are other disruptions that we haven't even thought of yet, that blockchain. So is blockchain a disruptive technology as well? So blockchain technology can actually displace industries as well as be a foundational technology. Here's some interesting examples of blockchain being used to supplement existing industries and what we call disintermediation, meaning that private companies are using blockchain basically to remove the intermediaries and further secure their market position. Some good examples are the Australian Stock Exchange and Maersk Shipping, two dominant players who are not looking to be disruptive. They are looking to use blockchain to lower their costs and again cement their position in industry. We'll talk a lot about strategies when we talk about the business case. So all of these systems, blockchain relies on cryptoeconomics in order to maintain their position and get into the market. And cryptoeconomics is really the intersection of economics and math. It's the use of incentives and cryptography to design new kinds of systems, applications, and networks. The incentives in the economic theory is really important. And all of these systems, all of these public blockchains use cryptoeconomics. Let me talk about what that means. So here's some systems from cryptoeconomics. Consensus protocols we've already talked about. So rather than using the high cost of a central trusted authority, cryptoeconomics says we're going to use the much lower cost, basically free community to validate and verify transactions, but it's not totally free because we're going to pay the winner, whoever does validate the transaction, with a little bit of this new currency that we're creating. All right, that's a consensus protocol. It's an economic system. It's an incentive system. It's part of cryptoeconomics. Another aspect to that is the fact that because of the way the system's set up, everybody in the community has a real incentive to support the value of the cryptocurrency, right? So that's part of the cryptoeconomics is they're going to act in a way that's supportive of the entire system. 2, application design, incentives used to prove applications. This is a way to get those first early adopters, first users out there to start using the product and getting it out into the market. Remember what I said about how network effect and lowering the value of network is really an important part of blockchain. Well, the fact that we can incentivize people for using early by giving them all sorts of incentive. We give them additional tokens, we lower the cost, etc. Lots of different ways that incentives are used in cryptoeconomics and blockchain that we'll talk about. So those are a couple of examples of how cryptoeconomics works with blockchain. We'll spend some time talking about Ethereum. Think of Ethereum as a transaction-based state machine. It reads inputs and transitions to a new state. That's how the computer scientists would refer to it. We're going to talk more about how it works in practice, what it is, and how it's different from Bitcoin. And people will say, well, Ethereum's different because it's Turing complete. What do we mean by that? Ethereum really has 2 accounts. the external account, which just like Bitcoin has public and private keys, and all it can do is send messages. In Ethereum, that message is Ether. That's the currency. It can't run any calculations on that. Then there's a second account. This is where the real power comes in. It's a contract account. There's a public address but no private key. But that contract account can store data and can run smart contracts, right? And can also collect messages. It can collect Ether, meaning that it can be paid. And that runs, the smart contracts run on the Ethereum virtual machine, EVM. And there's, again, a cryptoeconomic component to that, an incentive system, and a consensus mechanism for making that all work. So those are the two things that Ethereum does, and it's that latter thing that has made Ethereum so powerful and has allowed a lot of what's been going on in the Ethereum world, in particular dApps, which is distributed apps. Think of Ethereum as a decentralized app store where anyone can publish their apps on Ethereum. And unlike the other traditional types of apps, a dApp doesn't require a middleman to function. It just requires code. It's typically open source, it's decentralized, it's incentivized, and it uses software protocols. And then finally, we will talk a little bit about governance, because governance is very important to any of these systems for long-term sustainability. And by governance, that's really what we're talking about as a mechanism for change. Because this is all code, it's all software. It could be completely unchangeable, but that wouldn't last very long. So there has to be a way that we can have governance and a way to grow and to improve the software. And there are a lot of different ways that you see governance built into these systems, ranging from fully autonomous, where the code is completely unchanged, all the way to our existing systems where you just let courts decide if they have to, how changes should happen. But there are a lot of different ways in between. Smart contracts, very important. They are not very smart, and they're not contracts. What they are is computer protocols that just automatically make things happen. If you ever bought a candy bar from a vending machine, you used a smart contract. Why we're talking about it here is because Ethereum has allowed smart contracts to run on the blockchain. So they can run without people, they can run without intermediaries, they can run automatically, and we'll see how powerful that can be. And then finally, we'll need oracles in all of these systems. And an oracle is the party, everything I've talked about has been digital representations of real-world activity. Well, somebody has to find and verify that real-world data and events and submit that information to the blockchain to be used by the smart contracts. We call those persons or machines or software programs oracles. They really run interference. I should say they're a connection between the real world and the digital world. Okay, tokenization and ICOs. So now that we know how we can digitize products, we've seen the technology behind it, we've seen the business case for attaching digital code to different products. What does that mean legally? And there's a tax component, there's a legal component, there's a regulatory component, there are privacy concerns, there are data ownership concerns. We're going to go through all of that in our program here. Legally, the biggest issue, it's a couple of things. Number one that you hear about most often is securities. We've tokenized our product. So now my asset has a digital representation, and it's a valuable asset. It's going up in value. People are trading it. They're buying it for investment. They're trading it on exchanges. Do I now have a security? We'll talk about the securities law aspect. The answer is usually yes, or often yes, I should say, in the United States. Not so often yes in other countries. And that has profound implications for how this technology is used. The second big concern has to do with money, currency regulations. Is my digital asset a cryptocurrency? And if so, is it subject to regulation by FinCEN? That's the Financial Crimes Division of the Department of Treasury. If so, there's a whole nother level of regulatory compliance that must be complied with. We'll talk a little bit about patent issues. Is this stuff patentable? How do we protect it? What are parties doing in the market? And what are the states doing? with regard to regulation. And finally, of course, if it's not a currency, if it's not a security, is it maybe a commodity subject to regulation by the CFTC Commodities Futures Control? So thirdly, tax. How are these things taxed? We've tokenized it, we've created a digital asset, we've sold the asset. Am I going to be taxed on the proceeds from the sale of that asset? Or is it more like equity, where it's not going to be taxable? What's the IRS view of this, and what has the IRS been doing in this space? And then we'll look at some of the ancillary issues that come up. Privacy, it's immutable and transparent. Does that violate privacy rights? What happens if we're in Europe and we're subject to GDPR? What happens if we have health data that's being placed on the blockchain? Do we violate HIPAA? And of course, there's also issues as to who owns all this data, and is this a mechanism for consumers to actually monetize their data? The problem with the securities law aspect of this that's going to create so much conversation is that the U.S. has a very broad definition of security. Under the Securities Act, a security includes, notice the bold words there, an investment contract. And that's been very broadly interpreted to include not only what we think of as securities, but things as broad as rights to participate in orange groves, right? And that's the Howey test that you hear about a lot. As a regulatory matter, in 1934, the Securities Exchange Act was created, and it gave the SEC broad authority over all aspects of the securities industry, the power to regulate conduct in the market. So we'll talk about the 34 Act and how the 34 Act affects securities. The 34 Act created exchanges primarily. We'll also talk about the 33 Act. That's what we call the Truth in Securities Law. That's the law that requires that investors get full disclosure information concerning securities being offered for public sale. So both of those acts will apply to tokens typically. States have their own blue sky laws that regulate the sale of securities in their states. That's sometimes overlooked, but it can't be. We'll talk about the intersection of the state law and the federal law and how that applies to the sale of tokens, or ICOs. So as I said, first question, is the token a security? And we start with the Howey test. That's a famous Supreme Court test involving orange groves and what an investment contract is. And it's a very broad test. So a transaction is an investment contract if there's an investment of money, there's an expectation of profit from the investment of money is in a common enterprise, and any profit comes from the efforts. If there is a profit, it will come from the efforts of a promoter or a third party. That fourth one is oftentimes the big one. The SEC has taken a position that cryptocurrencies may be securities. They've also said they've never seen an ICO token that is not a security. So they've taken a very aggressive view of the extent of their jurisdiction over non-currency tokens and even some currencies. The SEC has been very active in this space. They've been warning people about scams. There unfortunately has been a lot of fraud involved in ICOs. That's initial coin offerings. That's where somebody digitizes their product or service, or even now their security, their stock, and sells it out into the market to the public. That's an initial coin offering, and the SEC has been watching these very carefully. There have been some very high-profile actions in this space. The DAO token was the first one we all heard about. That's when everybody in this space suddenly became a securities law expert. It was because of the DAO. The model described by the DAO was it's bad facts make bad law, was very much a security. They described it as a security. They said it's similar to buying shares in a company and getting dividends. So it wasn't hard for the SEC to say, hey, we're going to regulate these things as securities. Munchie, a little closer case, but that was a cease and desist. Munchie actually tokenized their restaurant meal reviews, and they used all the cryptoeconomics things I described. You got incentives for participating. People were actually part of the community. It's restaurant reviews. It's Munchie. But they targeted investors who invested with this expectation of profit rather than using the product or developing this ecosystem. They were looking to make money. So, and the marketing materials played to that as well. So the SEC determined that Munchie's token was a security, and they were are not in compliance with securities laws and require them to cease and desist. And there have been lots of recent ICO subpoenas from the SEC. They've subpoenaed many ICO companies to determine whether they're in compliance. The bigger problem, I think, with securities is not so much the SEC, because they've been going after the egregious cases for the most part. It's the private right of action. The Securities Act of 34 gives shareholders a private right of action to seek damages for securities fraud. And those cases are coming at a fast and furious pace, especially as the 2017 ICO boom has turned into a bust, and the underlying cryptocurrency values have fallen, and people want their money back, and they're suing under 10b-5, private rights of action. We'll talk about securities law compliance, what it takes to have a public offering of a token. Number two is Reg D is a private offering. Reg S is a foreign targeted offering. Reg CF is the crowd-funded offering. So there's various ways that tokens can be issued in complete compliance with the securities laws. It's not that tough. And we'll talk a little bit about crowdfunding as well. Commodities. The CFTC defines virtual currencies as a commodity, but they have different sorts of regulatory authority depending on whether somebody's trading in the currency or commodity itself on the spot market or in a derivative or a future. So commodities are defined in the Commodities Exchange Act. You'll notice it doesn't include onions, but it includes a lot of other things, and we have a U.S. District Court that says that the CFTC has authority over dealings in virtual currencies. So we have to be concerned about CFTC as well. And then finally, FinCEN, Financial Crimes Enforcement Network under the U.S. Department of Treasury. If it's determined that the token or the digital asset or the cryptocurrency is a currency for Department of Treasury purposes, then it's subject to all of these rules: Money Service Business Registration, Bank Secrecy Act compliance, Suspicious Activity Reports, and OFAC, Office of Foreign Assets Control. The tough one is the first one, Money Services Business Registration. It's a fairly onerous registration process and requires registration in the various states in which the company does business as well. That is sometimes a killer for most of these. Bank Secrecy Act is just the idea that transactions have to be reported, and banks and financial institutions should have good know your customer procedures in place, which we're already seeing pop up in all sorts of contexts for companies that are doing anything to do with crypto or tokens. Suspicious activity reports have to be filed when certain types of transactions occur, and of course OFAC, that's part of the anti-money laundering requirement that these companies have in order to make sure that the source of the funds is legitimate. So, interesting letter, February 13th of 2018, from the FinCEN, Department of Treasury, to Senator Ron Wyden from Oregon, who inquired as to what FinCEN's view of all this was. And they said three things in this letter. They said, a developer that sells convertible virtual currency for cash, for example, or another type of value, that could be cash, is a money transmitter. And they got to do AML, that's anti-money laundering, and know your customer. That apply to money transmitters, and they have to get into the system. Secondly, an exchange that sells coins or tokens for cash or virtual currency is also a money transmitter. But the third one was the toughest one, and that's the one that, or not the toughest one, but the most significant aspect of this, that said, however, these AML rules, these money transmitter rules, likely do not apply if the ICO is a security instead and is subject to regulation by the SEC, or is a future in a commodity and is subject to CFTC, and it'll just comply with their rules. In other words, if one regulatory agency regulates the token, the others might not, is what we're hearing here, especially FinCEN. And the significant part of this, the reason I said it was the toughest, is because we see a lot of tokens that bend over backwards not to be a security. And by doing so, they might bend over so far that they end up being a currency subject to FinCEN instead of SEC. So it's out of the pan and into the fire. Reg F crowdfunding, that's up to $1 million, small offerings to anybody. One of the exemptions that is being used more and more now for crypto, especially what we call security tokens. Utility tokens are tokens that have some use. They can be burned or traded for some product or service. Security tokens, as I use them here, means a token that's tied to that's very clearly a security, and it's tied to profits, appreciation, stock, or ownership of the issuer itself. Either one of those can be a security, even if it's called a utility token, and subject to regulation. Reg CF is one of the exemptions from registration of that token. And the good thing is that it can be sold to anybody, accredited or unaccredited. The bad part is you can only raise up to $1 million, and it's a relatively expensive exemption. Private offerings. This is the rule that says securities. Again, if our token is a security, who can we sell it to? Well, a security either has to be registered or exempt. One of the exemptions is that it's a private offering, and that means it can be sold to accredited investors. And you see the definition, it's a net income or net worth requirement. And under 506B, if the accredited investor self-verifies that they're accredited, they just tell you that they are, then the issuer is prohibited from doing any advertising or general public solicitation. The idea is that they're only going to talk to people they have some pre-existing relationship with. 506C, on the other hand, says that the security can be generally solicited, and almost always these token offerings are going to be publicly advertised and solicited. That's one of the things that makes it work. That's what they're after, the network effect. So we're almost always going to be in 506C. And again, that's fine. It's still a private offering so long as all the purchases are accredited. But now that we've advertised to people we don't know, the issuer has to verify that they're accredited. We'll talk about what that means. Reg A, we now have something called Reg A Plus. It's like a mini IPO and we've had it since 2012, where a company can go ahead and sell up to $50 million worth of its securities to anybody, accredited, unaccredited, but it is relatively expensive. They do have to file with the SEC. And as of this date, I'm not aware if the SEC has allowed a single one of these or approved a single one of these applications. And finally, Reg S, that's a safe harbor when the offering is deemed to be executed outside the United States. As long as we have the right representations and language and legends in our documents, we can rely on, say, Reg S for any investor accredited or unaccredited in another country. There are different types of safe harbors under Reg S, but for now, suffice it to say that we regularly rely on these in ICOs, because the ICO depends on having a lot of unaccredited persons using their tokens, getting the utility out of it, and creating a market, and creating that network effect. And that can't happen in the U.S. for all the reasons I just told you under the securities laws. It can happen in other countries that have a different definition of security, but to comply with the U.S. law, because we've got a U.S. issuer or a foreign issuer that's got a lot of contacts in the U.S., we comply with Regulation S. So as you can see, there's a lot of moving parts to a typical ICO. Usually there's a pre-sale of the product. In other words, we raise some money first before we even have a token, use the money to build a platform, build a token, and then later issue the token to investors, and at that point issue it to the earlier investors who advanced the money before the token was even created. And for their trouble, they get a little bit of a discount or a valuation cap or something like that. As you can see, there's a lot of parties involved in something like this. Legal, tax, foreign legal compliance, marketing, KYC, very important, AML, and of course the technical people. All right, the states have done a lot. Delaware has been at the forefront, as you might expect. They're committed to using blockchain technology. They've got it built right into their corporation's code that ledgers, that stock can be kept on the blockchain. and they are using it in their government as well by allowing UCC filings to be recorded and kept on the blockchain. Wyoming has been in the news a lot. They have very friendly cryptocurrency bills. They basically exempt a lot of crypto from regulations money transmitters. The problem and they have a property tax exemption, by the way. The problem in Wyoming is that it does not get you around federal regulation. You just don't have to worry about the state if you're willing to move there. Globally, Switzerland has been at the forefront. Singapore has been at the forefront. We've heard of Malta. There are others, Gibraltar, for example, Estonia, even Bulgaria. A lot of countries are really getting in on the act because this is something they see as being a very big market. And what we want really more than a lack of regulation is regulatory certainty. We don't have that in the United States, and other countries are racing to try to provide that. On the tax side, I will just say briefly here that one of the big issues here is, gee, are the proceeds from the sale of my token going to be taxable? Probably, unless it's purely a security token, in the sense that there's no pre-sale of a product or a company. It really just gives you some equity, or debt for that matter, in the company. How about when we use this crypto in exchange for something else? We'll talk about the tax consequences when that happens. So you trade suppose you buy a token, you use Ether to buy the token in an ICO, you probably have a taxable transaction. You've created one appreciated asset or another asset, and that's typically taxable. What about the company that issues a token in the ICO? Well, again, if it's a prepayment for goods or services that's taxable, we might be able to get a little bit of deferral. Information reporting, FATCA, FBARs, those concern themselves with foreign bank accounts and foreign financial institutions that have U.S. holders or U.S. signature authority. There is definitely reporting requirements in this space, and there are penalties. So these are all issues that we're going to explore in depth over the next 8 hours of lectures. I hope you can join us. I'm Roger Royse, I'm the founder of the Royse Law Firm. I'm here to talk to you about the Royse Law Firm Blockchain Initiative. You can find out more about us on the web at rroyselaw.com. And if you take a look at our industry/blockchain-technology page, you can find many interviews, articles, blogs, and slides concerning blockchain technology. I hope you'll join in and listen with us for the next lecture.